Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Welcome back to the deep dive. You know, when you look at the corporate landscape, you see these big headlines, right? A huge tech deal, a small company growing like crazy. And the focus is always on the outcome, the profit, the acquisition, the growth. But how do they actually, get there? The answer isn't some kind of magic. It's financial modeling. This is the architecture that turns an idea into actual numbers, and it drives every big decision. So today, we're doing a deep dive into the absolute core of corporate strategy. Our mission is to unpack 5 fundamental financial models, and for this, we're relying heavily on some fantastic material from the Corporate Finance Institute, or CFI.
And this really isn't just a theoretical thing for, an academic classroom.
Right.
If you're serious about corporate finance, investment banking, or even if you're running your own company, these models are a required skill set. They're the mental frameworks that top experts use to translate strategy into something measurable.
Okay, let's unpack this then. Start at the very beginning. If every decision needs a blueprint, where do we even start drawing?
You have to start with the cornerstone, the absolute foundation, the 3-statement model.
The 3-statement model.
It's the mandatory entry point. Its whole purpose is to create a holistic, linked view of a company's financial health. It forces you to look at the business not from one angle, but from 3 interconnected ones.
And those are the ones most people have heard of. The income statement, balance sheet, and the cash flow statement.
Exactly.
So we know them individually. Income statement is profitability, balance sheet is a snapshot of assets and liabilities, and cash flow tracks the actual money. But why is modeling them together so critical?
That's the key. What's fascinating here is the flow, the linkage. They're completely tied together. For example, the net income from the income statement, it flows directly into the retained earnings part of the balance sheet. And at the same time, changes on the balance sheet, like say in your inventory. That's what explains the difference between your net income and your actual cash from operations.
Oh, that's interesting. So if you have 2 companies and they both report, say, 10 million in net income,
right,
but one of them has a huge gap between that income and their actual cash flow, the linkage in the model would show you exactly where the problem is. It reveals the quality of those earnings.
Precisely. The model helps you spot where those differences are. It immediately shows you the impact of any decision. A big equipment purchase, a price change on profitability, on your actual cash, and on your overall financial structure. It's fundamental. FP&A, private equity, you name it.
So now that we know where a business is, thanks to the 3-statement model, the obvious next question is, where is it going? How do we pivot from diagnostics to, real strategy?
And that's the perfect transition to the next one, the forecasting model. If the 3-statement model is the historical X-ray,
then the forecasting model is the future projection.
Exactly. Its main function is to help businesses plan ahead, to project revenue, expenses, and capital needs, usually for, say, the next 5 years.
And here's where it gets really interesting, I think. It's less about a crystal ball and more about informed scenario testing.
Yes.
You can test assumptions, predict trends, and make choices based on realistic, model-driven scenarios, not just a gut feeling. I mean, this is what people in FP&A and strategic planning live and breathe every single day.
But, and this is a huge but, the forecast is only ever as good as the inputs you feed it.
Right. The old garbage in, garbage out principle.
Right. Which is why the planning model connects directly to something called an assumption schedule analysis.
Yeah.
This is what asks the hard questions. It asks, why are we projecting a 15% revenue increase? What operational levers actually support that?
So you can't just type revenue growth 15% into a cell and call it a day. What does this assumption schedule actually look like in practice?
This is a critical distinction. This is where the operational mechanics live. It's a detailed sheet where you calculate things like estimated units sold, variable cost per unit, your pricing strategy, maybe projected headcount, specific capital expenditures. All of these non-financial drivers
get linked directly to the financial statements.
Exactly. And the benefit here, connecting it to the big picture, is that it highlights cost drivers and inefficiencies before they become a problem. It forces you to decide where to put your resources, marketing spend, factory upgrades, whatever, for the highest impact. It makes sure your projections are grounded in reality, not just wishful thinking.
Okay, so we've established the historical foundation and the long-term forecast. Let's bring it back to the present. Let's talk about execution day to day, that immediate short-term viability. This feels especially critical for those, lower middle market companies where growth is rapid and cash is everything.
It's absolutely critical for them. And this brings us to the operational model. This is all about what they call operations management finance analysis. Its whole purpose is to make sure the business can manage its day-to-day liquidity, mostly through really solid working capital management.
Why is working capital so central here?
Well, think about it. Working capital, your inventory, your accounts receivable, your accounts payable, that's the lifeblood of the business operations.
Sure.
So this model tracks metrics like inventory turnover, days, sales, outstanding. It's what ensures a business can meet its short-term bills and avoid a liquidity crisis, especially when it's trying to scale up fast. Treasury management, small business planning, this is their bread and butter.
But wait, I have a question here. How is this operational model different from, say, the monthly cash flow forecast model? They sound pretty similar, like they're both focused on short-term money.
That's a really important question. The operational model focuses on managing the components, the efficiency of the cycle, how fast you turn inventory, how quickly you collect cash. The monthly cash flow forecast model, on the other hand, is a specific timing tool that guides those minute-by-minute decisions by predicting the precise moment cash will move. It tells you when a cash surplus, or more importantly, a shortfall is going to happen, down to the week, even the day. The source material breaks it down into growth, inflows, the resulting cash balance, and then outflows. You can literally see the gaps in the calendar. And that level of timing scrutiny leads to real measurable success. For instance, the sources pointed to a specific example of successful management where cost savings were measured at a very precise number. It was $94,896.
That's specific.
And that was a jump of over $57,000 from the prior year.
And a jump like that is not luck. It's the direct result of using a model like the monthly cash flow forecast to see exactly when and where you can save and reinvest every single dollar. So these two models together really turn abstract goals into stable day-to-day management.
Exactly.
All right, so we've covered stability, prediction, and the foundations. Now let's jump to the really big transformational moments, the major corporate events. Our fifth and final model is the merger and acquisition model, the M&A model.
This is the really sophisticated high-stakes analysis. This is investment banking, corporate development. Its purpose is singular, to rigorously evaluate the financial impact of a proposed merger or acquisition, to see if the potential strategic gain is worth the often enormous financial risk.
A lot of people probably think M&A is just adding the target company's profits to the acquirer's profits. That simple formula. Target plus acquirer equals combined. So why do you need a whole complex model for that? Why not just mush together their three statement models?
That's a great question. And what's fascinating here is that an M&A model goes so far beyond simple addition. It's necessary because the merger itself creates these huge non-cash accounting adjustments that can completely change the combined company's reported profits.
How so?
You have to account for the purchase price allocation. This often creates new non-cash assets like goodwill and other intangibles on the balance sheet.
Okay.
Then, when the acquirer amortizes those new intangibles, it creates a new expense on the income statement. This lowers the reported net income, even if the actual cash flow of the business hasn't changed at all. The M&A model is built specifically to handle those complex adjustments.
That's pretty technical, but clearly vital. So the model helps assess two really critical things then. First, accretion or dilution. Will the deal increase or decrease the acquirer's earnings per share?
Correct.
And second, synergies. The expected cost savings or new revenue from combining the two companies.
That's it. This is the definitive tool for figuring out if a deal is even feasible before you sign on the dotted line. You build the model, you stress test the synergy assumptions, and you see if the math actually supports the price tag. If the model says it's dilutive, the deal is probably dead, unless the strategic benefit is just, completely overwhelming. You need this level of insight to stand out as a top valuation expert.
So that's the roadmap. The three-statement model for a holistic view, the forecasting model for prediction, the operational and cash flow models for day-to-day stability, and finally, the M&A model for those big transactions.
Yeah, and the key takeaway really is that these 5 models are the tools that drive real business decisions all over the world. They let professionals map out the financial consequences of every single choice, from managing inventory to assessing a billion-dollar deal. They aren't just reports, they are active decision-making instruments.
Yeah. And for anyone listening who wants to go from just understanding these concepts to actually building these models themselves, the CFI sources we use today really highlight the FMVA, the Financial Modeling and Valuation Analyst certification. It's noted as an industry standard credential for people who want to build these advanced frameworks. So you now have a concise roadmap and hopefully a deeper technical understanding of the 5 most essential financial models used across the entire finance world.
So what does this all mean? If we connect this back to the bigger picture, think about how understanding these 5 models changes how you read a news headline about corporate profits or a major merger. You are now armed with the exact mental framework that finance professionals use every day to decide if something is a success or a failure. And here's something to think about as you go. Which of the 5 models we talked about, the holistic, the predictive, the operational, the cash flow, or the transaction model, which one do you think is most critical for, say, a brand new startup focused on just conserving cash versus a huge established company focused on transforming its market? The answer tells you a lot about how financial strategy has to adapt.
A great question to ponder. We will catch you on the next deep dive.
Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.